Thank you, David. It's nice to be here. No stress in my work, then or now. I've been exceptionally fortunate in the range of experiences I've had in public life and the people I've been able to work with. No greater privilege than working as part of this administration at this extraordinary time. I want to talk today about the global nature of the current financial and economic crisis and provide a bit of an update on the strategy we've put in place to help address this crisis. The world economy now is going through what, without a doubt, is the most severe crisis in generations. We each face somewhat different challenges. We're not all in the same boat, but we're all in the same storm. Important to underscore, though, that we now have in place a very strong framework of policies to confront the crisis. Our challenge is to put those commitments into action and to make sure that our actions are proportionate to the scale of the challenge. Now, although this crisis in some ways started in the United States, it is a global crisis. It's global in the sense that the damage is spread widely. It's global in the sense that the challenges we see in the United States today are common to many countries around the world. We bear in the United States a substantial responsibility, a substantial share of the responsibility for what has happened. But the factors that have made this crisis so acute and so difficult to contain lie in a broader set of global forces that built up in the years before the start of the present downturn. Never before has so much of the world been simultaneously hit by a confluence of economic and financial turmoil. The International Monetary Fund now expects the world economy to decline this year for the first time in more than 6 decades. The 1.3% decline forecast by the IMF represents a sharp deterioration from the roughly 4% annual growth rates which the fund estimates as trend growth for the world economy as a whole. And lost output in this context could be as high as $3 to $4 trillion this year alone. Several crucial lessons flow from the simultaneous nature of this crisis. The rest of the world needs the U.S. economy and the U.S. financial system to recover. We remain at the center of global economic activity with financial and trade ties to every region of the globe. But just as important, we need the world to recover if we're to prosper again at home. Before this crisis, U.S. exports were among our economy's fastest growing sectors, accounting for more than 6 million American jobs, or about 5% of total private sector employment in the United States. And now the export sector is one of the fastest shrinking sectors of the economy. Now, as a consequence of this, nations of the world must work together. That work has already begun, but we have to work together to lay the foundation for recovery and lay the groundwork for a new, more stable, more sustainable pattern of growth in the future. During the boom years, we all marveled at how globalization was speeding the pace of economic activity and integration. Now we're learning that in times of contraction, globalization transmits trouble with enormous speed and force, affecting economies around the world, the relatively strong as well as the more vulnerable. This crisis, though, is not simply a more severe version of the usual business cycle recession, the typical downturn in which economies ultimately adjust and stabilize. Instead, this is an abrupt, brutal correction of a period of financial excess that has overwhelmed the normal self-correcting mechanisms of economies and markets, and can only be ended by extraordinary policy response. Over the past 3 months, the President has moved quickly to put in place a comprehensive framework of policy initiatives to restore growth and to create jobs at home, and he's moved quickly to build consensus globally with other nations on a coordinated global response. This response reflects the 3 critical imperatives of the crisis. The First, it requires very strong actions to increase demand through fiscal policy, through investments and tax incentives, alongside the actions taken by central banks around the world. Second, it requires a sustained effort to repair financial systems so that we get credit flowing again to those who can use it most effectively. And third, it requires the mobilization of substantial financial resources to help directly address the challenges facing emerging markets and developing economies. Now, as you know, within weeks of assuming office, the President worked with Congress to enact the largest economic recovery plan in generations. By the time the plan has been fully implemented at the end of next year, we'll have injected nearly $800 billion into the U.S. economy, saved or created 3.5 million jobs, and raised our real GDP growth rates by 3 percentage points above what would have prevailed in the absence of that action. And in just over 60 days since passage, funds are already at work in communities around the country as highway projects break ground, and people are seeing more money today in their paychecks. Now, alongside our expansion plan in the United States, we've worked with other countries during the recent summit of G20 nations in London to put together an unprecedented cooperative program of fiscal stimulus. What makes this program so powerful is not simply its size, but the fact that nations are acting alongside each other to support demand with fiscal policy. This increases the effectiveness of each of our actions. Central banks started earlier in the crisis to move together to reduce interest rates, but those actions are now being matched by the actions of government on the fiscal front. Now, alongside these macroeconomic policy steps to support growth, this administration has put in place a comprehensive plan to help restart lending, support the flow of credit. These initiatives include programs to help bring more capital into the banking system, programs to help keep mortgage interest rates low, to help restructure mortgage payments, and thereby reduce the magnitude of potential further declines in housing prices. They include programs to help revive securitization markets, the markets that are critical to small business lending, to consumer lending, to automobile financing, to corporate lending, to commercial real estate markets. And they include programs to help restart markets for legacy real estate assets. Governments around the world are pursuing similar strategies. These programs are going to be tailored to the specific challenges, specific circumstances of each country's, but they all have the common objective of providing stability to the financial system, providing capital where necessary, catalyzing securities markets, and facilitating the cleanup of these legacy assets. These two types of programs, direct support for demand, economic growth, and efforts to repair financial systems, are necessary conditions for restoring growth. But these actions need to be complemented by other steps to support trade and mobilize resources for emerging markets and developing economies. So during the London summit, the G20 agreed to make more than $1 trillion available in financial resources through the international financial institutions principally to help support global growth and trade. The vast bulk of those resources will go to emerging and developing economies, which, as recently as the fall of last year, accounted for 42% of U.S. exports. This will improve their economic and financial health, and in turn will help improve ours. These programs have already provided immediate benefits in terms of confidence. They will make it possible for the governments of emerging market economies to act more quickly to support growth, to repair their own financial systems, and to help avoid the type of dramatic falls in exchange rates that were the feature of the financial crises in emerging markets of the late 1990s. And these programs act as a form of insurance policy for the world economy and therefore for the U.S. economy. Now, that's about the immediate imperative. But as we move to put in place this global framework of actions to address the crisis, the recession, we've also tried to make sure we're laying the foundation for a more stable, more balanced, and more sustainable global recovery. And this requires several things. First, it requires attention to the composition and to the quality of growth, both within our country, within countries, and across countries around the world. Second, it requires a cooperative effort to lay the foundation for more stable financial systems in the future, financial systems that are less vulnerable to recurrent crises. And finally, it requires that we commit now to unwind and reverse the extraordinary actions we have been compelled to take to address the crisis once the risks have receded and conditions for a durable recovery are in place. As we work to address the immediate crisis, we have to keep focused on these broader, longer-term imperatives so that, again, our actions lay the foundation for a future with fewer dangerous booms and destructive busts. A major lesson of this crisis is the remarkable overall performance of the global economy between 2003 and 2007 contained within it the seeds of its own undoing. And our goal, therefore, now must be a sustained expansion, an expansion that is better balanced. We have to set ourselves on a path so that one country or a group of countries does not consume in excess while another set of countries produces in excess. A more balanced recovery and expansion must be one where each nation is focused on growth that is sustainable and not dependent on the U.S. consumer. It will require a stronger focus on investments and incentives to improve productivity growth. And it will require a deep commitment to ensure that the gains of expansions are more broadly shared within our countries and across nations. Each of the major economies, including the United States, as well as the largest emerging market economies, share a responsibility for achieving this objective. And the IMF has a special responsibility to help us fulfill these obligations by offering independent assessments of our policy efforts and their impact on this common objective of putting in place a more balanced and sustainable recovery. On financial reform, we are collectively committed to reforming this 20th century financial regulatory system to match the 21st century financial structure of our time. This means that even as we reform our own systems, we have to move to reform the global system in tandem. The financial systems in our own markets and around the world have to do a better job of performing the critical function of efficiently allocating capital without promoting excessive risk-taking. And the G20 countries have taken a first step by agreeing on a common set of standards and principles to apply more evenly, more effectively around the world. Our aim is to promote a race to the top in global regulatory standards, not a race to the bottom. Now, we've employed extraordinary fiscal, monetary, and other government policies to deal with this crisis, but these are temporary and exceptional measures, and they need to be reversed when we've accomplished the immediate objective of generating recovery. With this in mind, the administration has presented a budget plan that charts the path to achieving sustainable budget deficits in the medium term so that recovery, and this is critically important, so that recovery is not impaired by concerns about excessive government borrowing in the future. We're designing our financial programs so that we can reverse them as soon as practical and avoid the risks that come with sustained government intervention in the financial system. And we have to make critical investments in healthcare, in education, in energy, in infrastructure to lay the foundation for a more productive economy in the future with the gains of growth more broadly shared. Now, our fortunes are more closely tied to those of the rest of the world than ever before, and our interests as a nation depend critically on the broader economic health of the world economy. In the years leading up to this crisis, U.S. exports of goods and services grew in real terms at an annual rate of almost 9%, nearly triple that of the overall economy. But by the end of last year, our exports were declining at a rate of almost 25% per year, the sharpest decline since the end of the Second World War. Our recovery depends on reversing this decline. American workers are among the most productive in the world, but we need the world to provide growing markets for our goods and services. This is not just an economic imperative. Our Director of National Intelligence, Admiral Blair, testified recently that the global financial crisis is the greatest near-term threat to this nation's security. He said, quote, "The longer it takes for recovery to begin, the greater the likelihood of serious damage to U.S. strategic interests." When economies decline, credit dries up, people lose their jobs, and children are unable to stay in school, hard-won gains for democracy and political stability are threatened, are at risk. As I said at the outset, we're not all in the same boat, but we're surely in the same storm. Today's crisis is unlike any we've experienced for 7 decades. The balance of payments crises of the 50s and the 60s, the oil shocks of the 70s, the debt crisis of the 80s, the Asian financial crisis of the 90s, they pale by comparison. Those crises were more localized. They had their winners as well as their losers. And as a result, international cooperation in those crises was slower to come. It was less effective and less powerful. In this crisis, in contrast, we've acted together to put in place a strong framework of policies to confront the crisis on a coordinated basis at an early stage, much earlier stage than you've seen the world react in the past. And the actions now in place and those in the pipeline offer the strongest basis for confidence that we will begin to lay the foundation for recovery. The rate of decline in global growth and trade has shown some signs of easing. Some measures of spending and output have started to stabilize. Financial conditions are starting to improve modestly. You're seeing some thawing in credit markets. And we've started to see some signs of stabilization, as I said, and declines of output and trade. And these are encouraging signs. But I want to underscore that progress is going to take time. And we still face together very significant risks and challenges. And for this reason, it's critically important that we continue to act. Governments around the world continue to act to strengthen the basis for recovery. We may have to adapt our policies further as conditions evolve, but we need to make sure, above all, that we provide a scale of support, we sustain the support, a scale of support that matches the intensity of the challenge. The financial world comes together in Washington later this week, And this will give us a chance to build on the commitments made by the G20 in London. I want to underscore, though, for this group and for the world, the commitment of our government, the government of the United States, of our country, to work with other nations to bring this crisis to an end and to put in place a more stable and more balanced foundation for growth in the future, not just for the United States, but for the world economy as a whole. Thank you for having me. I'd be happy to take some questions, David.
First question is, what economic indicators are you looking at to determine when we've hit bottom, and how will you judge what the biggest economic problems we are facing over the next 6 to 9 months are?
I think that you have to look at everything. There's no real single measure that captures the balance of risks and can give you a full picture of the challenges still ahead. I think it is important for people to recognize that the typical pattern of recoveries, and this will not be different, that even as growth stabilizes and starts to recover, unemployment will remain high for some time. And that's one reason why it's so important, again, even where you start to see some signs of traction stabilization, that governments keep providing support for demand, because you need to make sure that those resources are used productively, that we bring down unemployment over time, that viable businesses, again, have the chance to grow and expand. One of the big mistakes governments make in crises is they step on the brakes too early, or they ease up on the accelerator too early at the first sign of progress. Very important we not make that mistake. And so, again, even though, as I said in my remarks, it's very important that we lay a foundation for bringing ourselves back to sustainability, sustainable budget deficits, unwind these interventions of the financial sector, et cetera, it's very important that we have in place first a very strong, durable conditions for recovery before we shift to that long-term sustainability objective.
How do you compare the economic decision-making process of the previous administration with this administration and with the Clinton administration, which you were also a part of?
Well, I can't speak to the previous administration, but let me say a couple of things in that context. I believe you get best policy outcomes when you bring a group of people to the table with different interests and perspectives, and you look at the merits of alternative choices, you debate those merits, you focus on what the best thing to do for the country is, before you figure out what's achievable and how to make it work and have it put in effect, and that the best way to get good policy outcomes of the country is to run a carefully designed process, again, which brings diverse perspectives to the table at an early stage to sort through alternatives. And this president has brought together, putting me aside for the moment, put together an exceptionally talented group of people, and he is running just an excellent process to explore policy alternatives early stage, make sure we're focused on what's right for the country, not just over the longer term, not just in the short term, but over the longer term, and that we're prepared to do hard things, painful things, where we can make the case that they're necessary for the long-term future of the country. And I think that's in the best tradition of policymaking, and of course the world and the American people will judge us by our results. But this is the best way to get to better policy choices for the country.
Is the government considering any shift in borrowing toward longer-term bonds to take advantage of historically low interest rates?
Well, Treasury runs a very carefully designed, sophisticated process on the debt management side, and you'll see on an ongoing basis Treasury lay out plans for how to best meet these exceptional challenges of financing the near-term deficits. Deficits, of course, that are in some ways forced on us as the price of trying to resolve this crisis. But you'll see Treasury lay out, as it normally does, how we best balance those conflicting imperatives.
Can you comment on the manager selection process for the public-private investment partnership and the factors that will guide your decision?
Not more than what we've put out already in our term sheets and on our website. You'll see more details as we define them. But let me just say something about the objectives here. we had a financial system that, over a long period of time, took on too much leverage and, made a bunch, just to say it simply, a bunch of bad loans. And those loans are still sitting on the books of the financial system, and they're taking up room that could otherwise be used for creating new credit. And as part of the effort to help make sure there's enough capital in the financial system to support recovery, we put in place or laid out these funds and facilities to help provide a market for those legacy assets. And in doing that, we've chosen to use a model that has private investors come in and take risk alongside the government, to put real money at stake, skin in the game, to help making sure that the price at which those assets are purchased reflects a sophisticated understanding of the economic risk in those assets. Our judgment is that will end up will provide a greater potential of, again, creating a market for those assets, freeing up balance sheet room to support lending at less risk and less ultimate cost to the government. Again, the simple principle is if you have people taking risk alongside the government with their money at stake, you're going to get better judgments about what the economic value of these assets are. And you'll save the government from the risk that we would certainly have faced if we bought them ourselves of substantially overpaying for these assets. Also allows us to bring in private managers with professional expertise to manage those assets. Also helps reduce the risk to taxpayer over time. And our judgment again is that this approach is just overwhelmingly dominates the two classic alternatives. One alternative is to have the government alone come in and buy all those assets, make a choice about valuation, assume all the risk in getting that value wrong and in managing those assets poorly over time. That, again, in our judgment, would be much more expensive and not a sensible choice for the government. The alternative path is to hope that banks over time will simply be able to grow their way out of these problems, earn enough to over time to cover losses on those things. But that path will leave us with the risk. You still have a financial system that is not providing enough credit for recovery, a financial system that's generating stronger headwinds, deepening the recession, prolonging the recession. So again, our choice is to say it's better to help clean up those balance sheets through this market-based mechanism rather than leaving it untouched and hoping just over time the system will work its way out of this. And again, our judgment is that this combination of programs to bring capital into the financial system, provide a market for these legacy assets, these very powerful funding programs we're doing with the Fed to help restart securitization markets, they offer the best mix of programs to help resolve this crisis in the United States. And I just want to underscore that, again, we still face a lot of challenge and risk in the economy, both here and around the world, but we've already had a substantial amount of adjustment in our financial system. Our recession started 5 quarters ago, but the adjustment in the financial system started even before that. And so we are starting from a position where, and this is important to point out, that again, there's already been very, very substantial adjustment across the financial system. A lot of capital has already come into the system too, which will put us ultimately in a better position to, again, make sure the system's in a place, financial system's in a place where it's providing enough credit to support a strong recovery.
Do you expect to ask for more TARP money? And if people want to give back the TARP money they already have, why can't they do so?
As we said in the initial budget, where we put in a reserve fund against the possible contingency, we made additional resources, that if we get to the point where we believe to get through this crisis we're going to need additional resources, we'll go to the Congress and make that case. But we've not made that judgment yet, don't need to make that judgment yet. Congress has given us substantial resources. Our obligation now is to use those as most effectively as possible to get these programs working and underway. On the second question, we would welcome, of course, strong banks repaying the TARP resources. A lot of value in that. But the supervisors have to make a judgment about on what conditions that will be tenable for individual institutions. And as I said yesterday, it's very important that we underscore the fact that our obligation is to make sure the system as a whole is in a position where, again, it's not working against recovery, it's not deepening a recession by pulling more oxygen out of the credit markets, and has enough capacity to provide the flows of credit necessary to support a stronger recovery. That's what's guiding all our objectives. And that has to guide judgments in this context too. But ultimately, the supervisors have to make that choice. They're going through a process now where they're going to lay out criteria and standards for doing that. And my expectation is a substantial amount of resources will come back.
Are you worried about the impact of the debt of the United States government impacting adversely the dollar?
I'd like to say it this way, David, as I said in my speech. It is very important for the United States, as the President did in his budget, that as we put in place these extraordinary efforts to, again, get growth back on track, restore the financial system to some state of repair and strength, that we also lay out a path to bring our deficits down to a sustainable basis over the medium term. That is very important to do because the American people and investors around need to understand that we will have the will and the commitment as a country to go back to the point where we're living within our means. And that's going to require very substantial adjustments to bring our resources and expenditures more into balance. No one can feel more strongly than me about that imperative. It's a very difficult balance because, again, to get to that point, we have to get recovery in place. And the immediate challenge and the fiscally prudent, fiscally conservative response of a government facing a crisis like this is to expand spending and investments for a short period of time on a temporary basis. But again, you have to do that in the context of laying out a medium-term framework that bring those deficits down to a level where our debt burden is stable relative to GDP at acceptable levels. And that's what the President's budget laid out to do. And I think the resolutions passed by the Congress are consistent with that. Our challenge, of course, is to act with the Congress to make sure we deliver on those commitments over the medium term.
Since you have no other confirmed officials at the Treasury, are you sleeping there? And when do you expect there will be other confirmed officials?
We've got a terrific group of people at the Treasury working very hard, doing extraordinary things. And just to compliment them, let me just say a few things. It's been 90, what days? In 90 days, this administration, and just to speak to the economic side of it, has not just helped design this extraordinary package of investments, spending measures, tax incentives in the Recovery Act, a very substantial program of initiatives to help address the housing crisis, help strengthen the financial system, help get securities markets going again, help provide a market for these legacy assets. You've seen interest rates, mortgage interest rates come down quite significantly. Because of the President's programs, millions of Americans now will have the chance to refinance their mortgages, take advantage of those lower interest rates. That generates very, very substantial savings for the typical American who would otherwise not have been able to refinance to take advantage of these interest rates. You've seen us lay out the initial outlines of comprehensive financial reform. You've seen us move with countries around the world to put in place a strong consensus on again, you've never seen anything like this in terms of the strength of the consensus around a policy framework to help address recovery around the world. And again, you've seen the President work with Congress to lay out a very ambitious set of priorities in the budget on the domestic economic agenda that will not just help strengthen the productive capacity of the American economy over time through reforms in education, reducing growth in healthcare costs, encouraging more energy efficiency, strengthening infrastructure, but in a framework where we're credibly committing to bring those deficits down to a sustainable level over the medium term. So the people at the Treasury are doing a terrific job. They're working very hard, and they deserve a lot of credit for the scale of accomplishments and initiatives put in place in a very short period of time. I'm looking forward, though, to having a full complement of team, and I'm confident we're going to get, and we are getting, some just great people. You know, this is a moment where people want to come work for their country. We're all hoping that public service is compelling again, and I think you're going to see that in the team, in the people you see attracted to work for this president at this time across the administration, not just at the Treasury.
Related to that, you were minding your own business as the head of the New York Fed. Did you ever reconsider your decision to take this position in light of all the problems you've inherited?
I am. I feel deeply privileged, as I said, to have this moment. Look, you know, I really have spent my life in this world, in these jobs, and I feel a deep sense of obligation, particularly given the responsibility America bears for this crisis, to be part of this effort with this president and this Congress trying to fix this crisis and get us back to the position where the government of the United States is doing a better job of managing our country's economic fortunes, not just in the financial system, but more broadly. And if you do this, like I do and so many people do, you have to be here at this moment doing this. There is no plausible alternative. So I feel lucky to do it. It's a challenge, but it's a challenge that we live for.
Can you clarify your views on China's currency? Do you think it's being manipulated, or do you think it should be revalued in any way?
I have nothing to add to what we said in the report we issued last week. Just to provide the context for that, the world's going through again this extraordinary period. There's been extraordinary changes in the basic challenges facing emerging market economies, and transforming change in how you want to evaluate all the concerns that first led Congress to legislate that requirement, this report. So we tried to lay out those challenges, those changes. In the report, we tried to identify where there was substantial progress already been achieved, where we expect further progress ahead. But as I said in the report, our judgment is China's playing a very important stabilizing role in the global economy today. You just look at the actions they've taken to strengthen domestic demand, very strong financial response, fiscal policy response to the crisis. And they are committed to continuing this path of further evolution, their exchange rate regime, which is so important to China and so important to the rest of the world. But we tried to lay out a careful balance in the report. And obviously there's more work ahead for us and for everyone. And we're going to keep focused on those challenges. But the world's just changed dramatically over the last 6 months in the last reported issues, and those changes required a fresh assessment of that set of issues we traditionally have to cover in the report.
Do you think the government will get back its money from AIG?
AIG is still a extraordinary challenge, and but let me just say a few things, Dave, in that context. I want to say that Ed Liddy and the team he has there and the people of AIG are working very hard in the interests of the American taxpayer to try to put in place a tenable restructuring plan over time that separates the weaker parts of that firm from the stronger parts of the firm, that puts those strong underlying franchises of the insurance business on a better foundation to help improve the odds the taxpayer is repaid. And it's a challenge. It's a challenge not just because of the decisions that Liddy's predecessors made, but it's a challenge made much worse by what's happening around the world. Much harder to do anything today in this environment because of what's happening around the world. But they're putting in place, you saw in the papers today, latest signs of alterations to this restructuring plan, and we're hopeful they're going to be able to move forward and execute that on a reasonable time frame.
Okay, we have time for 2 questions or so from the audience. People can raise their hands. We'll get a mic to you. Anybody not bashful? No? Right here? Speak up. Stand up and speak up.
Three really important parts of the President's housing plan. One was to help make sure there was additional resources committed to the GSEs to make sure their borrowing costs stayed low. That is a necessary condition for this broader objective of trying to make sure that mortgage interest rates come down, stay low. Second was a refinancing program run by the GSEs that would enable, particularly in this environment where private mortgage insurance is no longer available, harder to get, enable families with higher loan-to-value ratios because the value of their house price has declined to refinance, take advantage of lower interest rates. That itself will make it possible for 3 to 4 million Americans to refinance who otherwise would not have that ability. Third key piece is the program you referred to, the loan modification program, where we announced the details on March 4th. Additional details have been coming out, moving quickly to put in place the remaining details of the program, sign up servicers, make sure they're moving quickly. But I think it's going to take a little time before you're going to see the data. And we're putting in place much stronger data provisions. People can see what's happening to modifications on a more frequent basis, more complete basis. But I think it's going to take probably a couple more months before people are going to be able to evaluate what's actually happening, what impact that's going to have. Now, of course, this program is a very powerful program, but it's not going to be able to prevent all foreclosures. The range of foreclosures are still going to be unavoidable. But this is, in our judgment, the best mix of incentives and changes to help address the broader challenges facing the housing markets in the United States. And again, I think the collective impact will be material in helping reduce the risks you get further declines in housing prices than you otherwise would have had.
One more question. Your Ambassador. Is the mic? Somebody has the mic? It is.
Because we are at the economic club and you are in charge of the overall economic policy priorities, I would like to ask you, United States is already a very big trader in the global economy, number third largest exporter of merchandise trade as well as manufactured trade, not only the financial services. When we go to the Congress, we feel some divergence between the priorities that is given to trade, promotion of trade between administration and Congress. What is the priority of U.S. administrations as a Secretary of Treasury, which is crucial to the recovery? Trade can be an engine of recovery for the United States and to the countries in East Asia. Thank you.
Well, I agree with you, and I think that I think it's clear from what the President has said and what he's done that he shares that basic commitment and that basic recognition that, again, our economic fortunes are tied to the fortunes of the rest of the world. And it's very important that we're working with other countries to help lay the foundation for more open markets, stronger trade ties going forward, and we will do that. One of the reasons why in the G20 meeting we put so much emphasis in trying to make sure there are going to be financial resources available to emerging markets on this exceptional scale was, they're going through this very, very dramatic withdrawal of private financial flows, very, very substantial shortfall in external demand, and left unaddressed, that would create the risk that those markets shrink much more than they need to shrink. So part of any credible action on the trade front is not just about what we do in terms of future agreements and in resisting pressures for new restrictions in our own markets, but in trying to make sure that economies around the world are growing more quickly, recoveries are firmly established. And again, you have never seen in decades, a program with this scale of financial force mobilized as quickly with enough potential to provide insurance protection against the risk that you have a deeper downturn induced in part by further weaknesses in emerging markets. So if you look at not just the scale of resources, but how they're being used by the IMF in new ways, how they're being deployed by the World Bank and the regional development banks in new ways, this is a very powerful program report, and I think you can see the promise of that program reflected in just what's happened behavior in markets since they've been announced.
Okay. We are at the end of the hour, so I want to thank the Secretary for his remarks and questions and answers. Thank you very much. Thank you. Okay.
Last time Vernon gave this to me, I dropped it.
Oh, okay. Thank you. Thanks.